Results out from ceramic industries this morning show a 114% increase in headline earnings a share to £11.31 for the year to July. That was off the back of an 11% rise in revenue to £1.6 billion. Joining me with more is Nick Booth. He's the CEO of Ceramic Industries. Nick, thanks very much for coming in today. Just continuing with that strike action, I think you had some industrial action over the course of the year at your sanitary ware division, and that did affect production there. How did you overcome it, and what's it done to your wage bill? Because it really seems to be a big issue at the moment across all industries where we are seeing those very high wage increase demands.
Thanks for having me, Stephen. Yeah, I think it's the nature of the season at the moment in terms of labour discontent. Yes, we did settle eventually at Better Sanitary, but we underwent a 3-month strike, which was very difficult from both sides. And it had an impact both on output as well as our ability to deliver to customers, and it's cost us market share for the longer term as well as allowed imported product into the market. I think when we reached settlement, it was probably not to the satisfaction of either side, and I think a compromise never is to the satisfaction of either side. But it was a case of the amount of time that people had been out of work did have an impact on the union side. And from our side, it was a case of we did need to get people back to work, so a compromise was reached. Well,
fortunately, that has been resolved, so we won't dwell on that. Just looking though at the numbers today, and at the first glance, it would look like the building industry's gone crazy, but there were a number of factors, of course, that drove your results so much higher. You had a lower tax rate. Finance income more than doubled to 21 million. That was due to interest on your positive cash balances. Finance expenses down. And of course, last year you also had a 49 million rand charge due to the Black Empowerment deal. If you strip all of that out, operationally, how did you do?
At operating level, we're up at about 20% above where we were a year ago, which I think is a solid performance, but due mainly to the tile side of the business. If you break it down into the tile side of the business and the sanitary ware side, we're down on the sanitary ware side, but up on the tile side of the business. This is a reflection, I think, of the new build activity in the market. In other words, reduced new build has a negative impact on the sanitary ware side, but we're seeing some pull on the tile side because of the renovation market starting to pull through for us.
Where in the market are you seeing the growth in your tile business? Are we looking at the top end of the market, across the market?
We see the pull really down in the lower part of the market to the middle, and it's mainly in the outlying areas of the country. We're seeing reduced or slightly reduced demand in the urban centres and a stronger demand in the outlying areas.
Now, you do say in the commentary that you saw that improvement coming through towards the end of the reporting period. Has it continued into the new year?
The demand has continued into the new year. We are seeing some negative impact from the cost side coming into the new year. We are only a month into our new year, so it's a difficult read at the moment. There is no doubt that we're seeing flat demand. I would say we're not seeing an increase or decreased demand. We're seeing year-on-year flat demand, which we saw really pretty much in the last year. What we got some benefit on last year was we managed to get our volumes back up because we reduced stock levels. So we were able to get some economies of scale kicking through and reduce our cost of production, unit cost of production on the tile side of the business.
You mentioned cost pressures. Where are they coming from?
Mainly from energy, obviously. Electricity has come through for us. And then on the gas side, with the oil prices starting to climb again. And then obviously on the labour costs.
Of course, because you do point out in the commentary also that there have been operational efficiencies, better selling prices that's added to your margins. In fact, average selling prices up 5%, volumes up 8.4%, production up 18%. So it looks like it really is all steam ahead for the tile business.
Yeah, the tile side doing fairly solidly. And again, as I say, demand from the renovation market helping. The average selling price increase is not from price increases, but rather an improved mix. We're able to create a bit of demand on fashionable tiles, which helps bring up the average selling price for us.
And also compare perhaps the South African and the Australian markets, because you are quite big in the Australian market as well, aren't you?
Yeah, we're now producing or selling into the Australian market about 18% of the volume sold in Australia. The upside there really has been the government subsidies on new housing, which has created a demand for product through all the different states. They started to die down a little bit in Queensland in the last 2 or 3 months, but we're still seeing sustained demand in Victoria and New South Wales.
How do margins in Australia compare with the margins here in South Africa?
Margins generally lower than South Africa, in the order of about 10% lower than we would see in South Africa.
And then how about the exchange rate? Because obviously if you are operating in Australia, you do have that forex factor coming into it, but we've seen the Aussie dollar also quite strong, haven't we?
Yeah, the rand and the Aussie dollar generally tracked each other. We've weakened slightly against the Aussie dollar over the year, which has given us some forex gains on our statements, on our financial statements. But But generally, we've tracked the Aussie dollar, and therefore, when the rand is strong, the Aussie dollar is strong against the US, which is what most of the imported product is brought in is US dollars.
Yeah, and of course, when we have the strong rand, it does make those imports cheaper. Is that raising the bar in the competition stakes for you?
For sure. I think at any stage where you're competing with the Chinese, strengthening currency is a disadvantage.
Well, you talk about a declining market for sanitary ware, of course, that new builds really on hold at this stage. How about the government sector? Are you starting to see any signs of life coming through from the government sector for housing?
We're finding it's very much a provincial type thing, depending on the capacity of the province. So we're seeing fairly good demand out of Gauteng and the Free States as an example, but declining demand in Mpumalanga, Northwest Province.
You had that nice increase in your interest, 21 million. Cash reserves up from 155 to 436 million. You did say there has been limited capital expenditure during the period. Are you planning to step up CapEx going forward?
We're looking into a number of projects, one of them being a new factory that we're looking to build in the Vereeniging area, which will be an investment of some 450 to 500 million over 2 years.
And will you fund that from your cash reserves?
The idea is to fund it from cash reserves, correct.
And just quickly, the prospects for this year, you have said that it looks pretty stable at this stage, but not much of an improvement.
There's not going to be no great excitement in the coming year. It's going to be a flat year-on-year performance.
I'll talk to you in 6 months about that, Nick. Thanks very much for coming in today.